Hi there, and welcome to our video on Options 101 Understanding the Basic of Options Trading. Today, we're going to take a deep dive in how to understand basics of options trading and how they work, specifically for beginners. Let us have a brief knowledge about options trading. Options trading is a financial strategy that involves trading contracts known as options. An option is a derivative security that gives the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, known as the strike price, within a specific time frame. There are two types of options, calls and puts. A call option gives the holder the right to buy the underlying asset, while a put option gives the holder the right to sell it. One example of option trading is buying a call option. Let's say an investor expects the price of a particular stock to increase in the near future. They can purchase a call option on that stock, which gives them the right to buy the stock at a predetermined price before the option expires. If the stock price rises above the strike price, the investor can exercise the option and buy the stock at a lower price, allowing them to profit from the price difference. Now let's move into Options 101 Understanding the Basic of Options Trading. 1. Options Basics. Options are financial instruments that provide the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a specific time frame. Call options give the holder the right to buy the asset, while put options give the holder the right to sell it. Options have an expiration date, after which they become worthless. The predetermined price at which the asset can be bought or sold is known as the strike price. 2. Option buyers and sellers. In options trading, there are two main participants, buyers and sellers, also known as writers. Option buyers pay a premium to obtain the right to buy or sell the underlying asset. They have the choice to exercise the option or let it expire. On the other hand, option sellers receive the premium but have an obligation to fulfill the terms of the option if the buyer decides to exercise it. 3. Factors affecting options. Several factors influence the value of options. The price of the underlying asset is a significant determinant, as options tend to increase in value if the asset price moves in the anticipated direction. Volatility, the measure of price fluctuations, also impacts options. Higher volatility generally leads to increased option prices. Time to expiration is crucial, as options lose value as they approach their expiration date. Additionally, interest rates can affect option prices. 4. Trading strategies. Options trading offers various strategies to suit different objectives. For example, buying call options can be a speculative strategy to profit from an expected rise in the underlying asset's price. Conversely, buying put options can be used to speculate on a price decline. Selling options, such as covered call writing, can generate income by collecting premiums while already owning the underlying asset. There are also more complex strategies, like spreads and straddles, which involve combinations of multiple options contracts. 5. Risks and risk management. Options trading carries risks that should be carefully managed. One risk is the potential loss of the premium paid if the option expires worthless. Additionally, options trading can be volatile and complex, requiring a thorough understanding of the market and asset behavior. Proper risk management techniques, such as setting stop-loss orders or position sizing, are crucial to limit potential losses. Traders should also be aware of their risk tolerance and avoid investing more than they can afford to lose. Real-life example of options trading. Let's say an investor believes that ABC Incorporated's stock price will experience significant volatility due to an upcoming product launch. To capitalize on this potential price movement, the investor decides to employ a strategy known as a long straddle. This strategy involves purchasing both a call option and a put option on the same underlying asset, with the same expiration date and strike price. The investor buys a call option with a strike price of $100 and a put option with the same strike price of $100. The options have an expiration date of 1 month. By buying both options, the investor profits if the stock price moves significantly in either direction. If the stock price rises above $100, the call option can be exercised to buy shares at a lower price, and if the stock price falls below $100, The put option can be exercised to sell shares at a higher price. If, for instance, ABC Incorporated's stock price surges to $130, the call option can be exercised to purchase shares at $100, resulting in a profit of $30 per share. On the other hand, if the stock price drops to $80, the put option can be exercised to sell shares at $100, again yielding a profit of $20 per share. However, if the stock price remains relatively stable and does not deviate significantly from the strike price of $100, the investor may incur losses due to the premium paid for both options. Option trading provides investors with a way to profit from volatility in the market without having to take a directional bet on the stock's price. The use of options allows for greater flexibility and risk management. However, it's important to note that options are time-limited instruments, and if the stock price fails to move significantly during the option's lifespan, the investor may experience a loss due to the premium paid for the options. Benefits of option trading. 1. Flexibility. Options provide investors with the flexibility to implement a wide range of strategies. Traders can use options to speculate on price movements, hedge existing positions, generate income through covered call writing, or limit risk with protective puts. 2. Leverage. Options offer the potential for significant leverage. With a relatively small investment, the premium, traders can control a larger underlying asset position. 3. Income generation. Option trading can be a source of income generation. By selling options contracts, such as covered calls or cash-secured puts, investors can collect premiums and generate regular income. 4. Diversification. Incorporating options into an investment portfolio can enhance diversification. Options allow investors to gain exposure to various asset classes and markets without directly owning the underlying assets. 5. Risk management. Options can be used effectively for risk management purposes. By employing strategies like buying protective puts or selling covered calls, investors can protect their portfolios against adverse price movements or generate additional income to offset potential losses. In summary, option trading involves buying and selling options contracts based on underlying assets. It provides investors with the flexibility to speculate on price movements, hedge against potential losses, and generate income through options writing. While offering leverage and risk management opportunities, option trading requires careful analysis and risk assessment due to the potential loss of premiums and the limited lifespan of options. In conclusion, understanding options trading is crucial for individuals looking to engage in this financial strategy. Options provide investors with the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a specific time frame. By comprehending the basics of options trading, investors can benefit from the flexibility, leverage, hedging, and income-generating opportunities that options offer. However, as with any investment strategy, it's important to do your research and consult with a financial advisor before making any decisions. We hope you found this video informative, and we encourage you to like, subscribe, and leave a comment below with any questions or feedback. Thank you for watching, and we look forward to bringing you more informative content in the future. And we'll see you in the next video.